Welcome to Casa Academy Chapter 12, Part 1, where we will cover residential mortgages. Today, we're going to explore why financing is considered the true lifeblood of the real estate market. I'm absolutely thrilled to guide you through this material because understanding the real anatomy of a mortgage is absolutely critical. It isn't just about passing your licensing test, it's about knowing exactly how the real estate world actually turns.
So let's dive right in by recognizing a fundamental truth of our industry. When financing is readily available, buyers can purchase homes easily, and our market stays active. The flow of money literally dictates the pace of the market. Conversely, when financing gets tough to obtain, real estate activity slows way down. This dynamic makes mastering these financing concepts a real game changer for your future career.
Here is our syllabus for today's explainer to help you structure your notes and conquer the exam. We'll hit the power of financing, Florida's lien theory, parties and clauses, costs and points, qualification, and finally, judicial foreclosure. Section 1. The power of financing. Most residential real estate purchases involve some type of financing, meaning that without it, market activity slows down significantly. In fact, many industry pros consider financing to be the absolute lifeblood of the real estate market. But before we can even begin talking about the different types of loan products out there, we really need to understand exactly what a mortgage is and how it functions specifically in the state of Florida.
Moving right along to Section 2, Florida's lien theory.
Now, in Florida, getting a mortgage doesn't mean the lender owns your property. You do. Florida is strictly known as a lien theory state. This means you, the buyer, retain ownership, while the lender simply holds a legal claim, or a lien, against the property. The lender absolutely does not become the owner just because they fronted the cash. To formalize this whole arrangement, the borrower signs two very distinct, very important documents.
To cement this for your exam, you've got to remember the difference between these two. First, we have the promissory note. This note is the borrower's actual promise to repay the loan. It outlines all the crucial terms like the amount borrowed, the interest rate, the repayment period, and your monthly payments. The second document is the mortgage itself, and that gives the lender their legal lien. A really helpful way to remember this? The promissory note creates the debt, while the mortgage secures the debt.
And this is completely different from title theory states where the lender might actually hold the title to the property until the loan is totally paid off. Because Florida is a lien theory state, the lender merely has a lien against the property, but they do not own it. This distinction is highly testable, so definitely make sure you've got it highlighted in your notes.
Let's jump into Section 3, parties and mortgage clauses.
Students mix these terms up all the time, so the key here is to focus on who is actually giving the mortgage. It sounds backward at first, but think of it like this. The borrower is pledging their property as security. They are giving the mortgage to the bank. Therefore, they are the mortgagor. The lender, on the flip side, receives the mortgage, making them the mortgagee.
Now, these mortgage documents contain a bunch of clauses designed to protect both the lender and the borrower. For instance, a tax clause lays out how property taxes will be handled. A maintenance clause requires the property to be kept up to preserve the lender's collateral. And a prepayment clause dictates whether the borrower can pay off the loan early and if there are strings attached to doing that. Also, as we're going through this, your verification code is 489778. You'll definitely want to review the rest of the clauses in your materials for both practical knowledge and exam prep.
Section 4. Costs and discount points.
Closing day is always exciting, but it brings a ton of paperwork and, of course, fees. When a mortgage loan closes, you've got recording fees, title insurance premiums, and various escrow-related costs. But let's take a closer look at discount points, because these are frequently misunderstood by new students.
A single discount point equals exactly 1% of the total loan amount. But what actually is it? A discount point is simply prepaid interest. By choosing to pay this extra money upfront at closing, the borrower can snag a lower interest rate. Traditionally, each point you pay reduces the interest rate by about 1/8 of 1% over the life of the loan, which can really reduce the long-term cost of borrowing.
Section 5. Qualifying property and borrowers.
Before handing over the money, lenders assess risk on two parallel tracks. They look at the property, and they look at the person. First, qualifying the property ensures it provides enough collateral. This means getting an appraisal to estimate market value and a survey to check boundaries. At the exact same time, the lender has to qualify the borrower to make sure they can actually repay the loan. That means diving into credit history, verifying income, checking existing debts, employment history, and debt-to-income ratios.
Section 6. The judicial foreclosure process.
Remember how we hammered home that Florida is a lien theory state?
Well, because of that, a lender can't just swoop in and take ownership of a defaulted property. If a borrower stops making their required payments, the lender is legally required to go through the court system to get a foreclosure judgment. Foreclosure in Florida is strictly a judicial process.
If the court grants the foreclosure, the property usually goes to a foreclosure sale or an auction. The cash from that sale is then handed out according to lien priority, meaning the most important liens get paid off first. Any remaining funds trickle down to satisfy lower priority liens. And here's a really fascinating detail. If there's any money left over after all liens and expenses are paid off, those excess funds are actually returned directly to the borrower.
All right, lesson recap.
We covered a lot of ground today. We learned that most residential transactions use financing. Lenders qualify both the property and the borrower, and discount points are just prepaid interest. But your absolute must-know takeaways are these. Florida follows the lien theory. The borrower owns the property, the bank just holds a lien. The note creates the debt, the mortgage secures it. The borrower is the mortgager, and if things go south, foreclosure must proceed judicially through the courts.
Thank you for joining this lesson. I'll leave you with this final thought. Understanding the exact anatomy of a mortgage isn't just a hurdle to jump for a test. It's about becoming an irreplaceable guide for your future clients. When you can confidently explain why Florida is a lien theory state, or how a discount point can save them thousands over the life of their loan, you instantly elevate yourself from a salesperson to a trusted advisor. So as a future real estate pro, how will mastering these financing fundamentals change the way you advise your buyers on day one?